Welcome to the Pro Ticker Deep Dive. So today we're taking a really close look at the U.S. housing market. For you, tracking the sector, things definitely feel a bit wobbly. And it brings up that huge question. Is the whole foundation actually cracking now, or is this just a really painful adjustment because of interest rates?
That really is the core conflict we saw in the source material. It's not one single market story. What we're seeing is this dramatic split.
Mhm.
On one hand, yeah, the major home builders, they're clearly struggling, lots of investor pessimism there. But then on the other side, you see this surprising strength, even like growth, in companies tied to home improvement and repair.
Right, like two completely different housing markets running side by side, different rules, different winners. So our mission today is basically to give you the shortcut, help you understand that split.
And we really have to start with builder sentiment because honestly, it is genuinely bearish. The mood among the new construction folks, tracked by the NAHB sentiment index, it's stuck near lows we haven't seen in years. And it's all being driven by these persistent affordability problems and just the stubborn fact that rates look like they're staying higher for longer. So this deep dive, we're really going to try and isolate why certain parts of housing are weathering this particular storm way better than others.
Okay, yeah, let's unpack that investor nervousness. Because just recently we saw housing stocks, specifically those big home builder indexes, drop about 9%. And the wider market indexes barely moved. That seems like a really loud signal. Investors are seriously rethinking 2025 growth for new builds.
Oh, absolutely. And the nervousness, well, makes sense. Builders are caught in this intense tug of war. They've got high interest rates squashing demand, but they also still have that backdrop of, historically tight supply of existing homes for sale. But right now, the affordability squeeze is definitely winning that fight.
We did see the 30-year mortgage rate dip a tiny bit to around 6.43%. Sounds maybe like a small break. But maybe it's just cosmetic, especially with what's happening elsewhere in the bond market.
It feels cosmetic, yeah. The real pressure is coming from the long end, the 10-year Treasury yield.
Yeah.
It climbed up to 4.14%. When that Treasury rate is high, it spreads the gap between the Treasury yield and the actual mortgage rate really wide. And that just keeps squeezing buyer budgets,
Yeah.
choking the market from the top.
And if you look at how buyers are trying to cope, well, there's a bit of a red flag in the application data, isn't there? What about that jump in adjustable rate mortgages, ARMs,
Yeah.
up to 9.5% of new applications? What's that telling us? Stability or risk?
That tells us buyers are getting pushed into, let's say, more creative, maybe riskier strategies just to make the monthly payments work, which historically that signals more risk kind of creeping into the system. An ARM gives you a lower payment up front, sure, but then you're exposed to future rate hikes, and you combine that with demand just generally cooling off. The MBA purchase index slipped another 1.2%. It really suggests even that little bump we saw in summer demand is fading as we get deeper into fall. People's wallets are just stretched thin.
Okay, let's circle back to that NAHB sentiment index. That's the builder's own report card, and yeah, the numbers look pretty bleak. Why is the expectation that it'll only tick up maybe 1 point, 33? Why is that such a big warning sign? Because of how the index works. 50 is the break-even point. So anything below 50 historically means more builders see conditions as poor than see them as good. And when you're stuck down at 33, that's not just cautious, it's signaling deep contraction. Builders know they have to use aggressive incentives, paying closing costs, buying down rates just to shift inventory. And that chews right into their margins, which are already tight, which, feeds back into that investor pessimism we started with.
Right. So demand side is clearly softening. Builders are struggling with margins. Okay, what about the supply chain? Are they getting any relief on costs?
They are, actually. And this is where the picture gets, well, interesting. Construction costs are definitely starting to show some softness, especially lumber. The builder lumber index fell about 14% year over year.
Wow, 14%. That's a pretty big drop. What does that softness in lumber really tell us about the wider new construction market? It tells us two key things, really. First, yeah, supply chains have definitely normalized more, which helps with efficiency. But maybe more importantly, the speed and size of that price drop. It hints that demand for new builds has cooled off enough that it's actually reducing the pressure on materials. Builders aren't desperately fighting for every 2x4 right now. That's a real shift from the last few years. The pressure's moved from input costs to actually selling the finished house.
And the company results, the corporate scoreboard, it reflects that pain pretty broadly, right? This isn't just one or two companies having a tough time.
No, not at all. Across the board, the major builders, the big large cap ones, the smaller regional players, they all posted declines recently, high single digits mostly. It just reinforces that this correction in the sector is broad Investors are basically treating new construction as one group, super sensitive to interest rates, regardless of their specific location or size.
Okay, so this brings us right to that really fascinating split, the divergence. If the builders are taking such a hit, why are the companies on the building product side, the ones supplying insulation, flooring, HVAC systems, remodeling stuff, why do they seem so much more resilient? Some are even doing well.
This is absolutely the core of the story. We're calling it the stay and renovate economy. Homeowners are basically adapting to high rates by, well, staying put. Think about it. Tons of people locked in mortgages over the last decade at like 3, maybe 4%. Those low rates, they act like golden handcuffs. It's incredibly expensive financially to give that up.
Ah, right. So they're financially kind of stuck in their current house, even if it's not perfect for them anymore.
Exactly. And if you can't afford to trade up or move to a bigger place because the new mortgage payment would, like, double, then your priority totally shifts to improving the place you already own. So demand for quality repair work, remodel projects, adding insulation, upgrading the kitchen, replacing that old floor, that becomes really steady, almost necessary, regardless of what new home sales are doing.
And we saw that play out really clearly in some specific company results. Tell us about that one standout performer, the one that did well when the builders were tanking.
Yeah, it was striking. We saw one major building products supplier actually gain over 8% in the same week the builders were selling off hard.
Yeah.
And others, like a big flooring company, they're still seeing support because the remodeling categories are holding up or even improving. This divergence just perfectly highlights it. The tools and materials side is weathering the storm because they benefit when homeowners pivot from moving to improving.
They don't need new houses being built nearly as much. They need existing houses to be fixed up and upgraded. That's a really key difference in what drives their demand.
It absolutely is. The building products companies are much more insulated from the mortgage rate swings that are just crushing the builder's outlook. Their success is driven more by, necessity, the simple aging of houses, not by whether new buyers can qualify for a 6.5% mortgage.
Okay, let's pivot then and look forward. For you, the listener tracking this market, what are the risks and opportunities here? What does this deep dive suggest for the near term? Bearish? Or is there a quiet bull case?
Well, you have to balance the two clear views coming out of the source material. The bear case. It's still loud, still pretty convincing. Why? Because that affordability crunch is just persistent. We already talked about sentiment risk, that NAHB index likely stuck way down at 33. And that suggests builders are going to keep having to use those margin-killing incentives just to move houses through the winter months. So the consensus is, yeah, margins could stay under real pressure for a while, which kind of justifies that recent sell-off in builder stocks.
But then there's the bull case, maybe quieter, suggesting, hey, maybe the worst news is already baked into the stock prices.
Correct. A lot of the valuations for these builders are now back to what analysts might call mid-cycle levels, which means they're already priced as if we're in a slump, not a boom. So if the Fed even hints at softening on rates, maybe signals cuts down the road, demand could snap back surprisingly fast because fundamentally that decade-long shortage of housing, it hasn't vanished. And interestingly, housing starts and building permits, while slow, are actually projected to maybe inch up about 1%. It suggests the supply side hasn't totally seized up yet.
And we can use the technical charts, the market data itself, to see how the market is actually voting on these two different areas right now. We talked about the split in performance. Is it showing up in the charts too?
Oh, absolutely. It's crystal clear. For the home builders, their index, the Home Builder Index, it recently broke below its 200-day moving average. That 200-day line is kind of seen as the market's long-term trend indicator. Breaking below it,
Yeah.
classic warning sign. Negative momentum, heavy selling. It screens caution, short-term at least, confirming those investor fears.
Okay, and what about the renovation side, the building products?
Total opposite. The Building Products Index is trading comfortably above both its 50-day and its 200-day averages. The 50-day is more of a shorter-term trend line, so trading above both. That shows strong relative momentum. It suggests the bulls are winning the argument there for the longer term. That technical split just perfectly highlights where investors seem to see the more insulated long-term winners right now, companies tied to remodeling and retrofitting.
So what does this all boil down to for you? If we strip away all the noise, the day-to-day rate volatility, the housing market overall isn't really broken. It seems like it's going through this deep recalibration, that long-term shortage of homes. Still there, but for right now, yeah, we clearly have two very different markets playing out. You've got the struggling new home construction sector really grappling with high rates, and then you have this quieter but thriving home improvement market benefiting directly from people staying put.
Exactly. The underlying resilience in housing demand is definitely deep. It's driven by basic needs. But the builders, they really need lower rates and probably some time to adjust their inventory and pricing before their stocks likely stabilize. Meanwhile, the building products companies, they're sort of quietly benefiting from the situation those higher rates created. And this whole situation, it raises a really important question for you, the learner, to think about. When the next housing upcycle eventually kicks in, when rates finally stabilize or even drop, which side of this housing equation, the newly unleashed construction market or this now huge entrenched home improvement market, which one will offer the strongest bet for the long run?
See you all in the next Pro Ticker Deep Dive.